Right now, let's talk some macro. Marta Norton joins us here, Chief Investment Strategist at Empower, formerly the America's Chief Officer at Morningstar. Great to see you again, Marta.
Good to be here, Oliver.
Tell us about the new gig. It seems like you guys are very retirement kind of focused, right?
Yes, absolutely. So Empower has a huge retirement presence. It has a big wealth effort as well, some investment products. So I joined Empower to kind of build out the investment insights and provide that fundamental long-term orientation to the individual investor.
Okay, well, we love hearing it, so glad to have you back.
Yes.
This has been now last couple months since we last spoke, since you started a new gig, a pretty volatile one. Obviously, we had this monster event that's like it came and came and went in this amazing fashion, vol 65, then back to 16. What's kind of been your top line takeaway from that?
Yeah, it's been super interesting. I think a lot of the narrative for 2024 has been that the soft landing is intact, and there was really no questioning that. And I think the summer storm that we saw this year was the market thinking maybe things aren't as rosy as we thought they were, and that relates both to the jobs report, the payroll restatement, what we saw with the carry trade, and of course questioning the AI narrative. So it was like a lot of the things that were driving the market forward in 2024 came into question at exactly the same time.
Yeah, like exactly the same time, right?
That's right.
How important is it to link what happened the first week of August to the preceding kind of 4 weeks when the NASDAQ kind of rotated into this small cap thing? Because that's what's been trying to come back here the last couple of weeks.
That's right. There's certainly been a rotation trade that took root earlier in the summer, but then the sell-off, kind of uniform, all markets kind of suffering. And then there's kind of a vying for leadership in the recovery since then. I think a lot of the narrative that I think is pretty credible around what's happening with that rotation trade is, where the Fed is going and pairing a soft landing narrative with potential Fed cuts. And certainly that favors some of the more cyclical areas like small caps and maybe is less of a tailwind for some of those AI companies that have been everybody's favorites.
I think you put that very well, the vying for leadership since the bottom. That's been an important theme and one that I think maybe going to come to some conclusion like in the next 48 hours because if NVIDIA just does something amazing again or horrible, like that could really create a bifurcated market again.
And no question that everyone's going to be watching NVIDIA. And of course, it's because NVIDIA is part of everyone's portfolios. It feels like it's 6%, of indexes. But it's also because I think NVIDIA is a representation of the AI enthusiasm, the AI trade. And when we looked at earnings earlier in the past few weeks, and we think about some of those other big tech companies, a lot of them are spending so much. And of course, NVIDIA is the beneficiary of that. So I think that's where investors are really focusing. Are we going to continue to see NVIDIA deliver? Is that CapEx continuing? Are there going to be any delays in the production? And what does this mean for AI more broadly?
When you have that concentration still in the index,
yes.
What does that decision process look like, especially from the perspective now where you're kind of thinking about retirement too? There's now this skew towards a few companies that's still in there, even though the market's seen a little bit more breadth come back. Because then the questions I get, people say, they go, all right, well, this works so well for me, but if the Fed is going to go on this big downshift in cycle, and it's not just going to be one, it's going to be the new beginning of a rate cut cycle, then history tells us we're supposed to be in like small caps and taking more risk and stuff like that.
That's right, as long as the soft landing holds.
Exactly.
I think it's a pretty interesting question for the passive investor. And it's almost like every American is a passive investor.
100%, pretty much, yeah.
So all of these companies taking up, and especially NVIDIA, taking up a lion's share of their portfolios. I think there's a few considerations to keep in mind. One is that valuation is a bit more of a risk. That's where the overvaluation is concentrated in these mega cap AI growth names. And I think a second consideration that is a little bit of a softening of that is that these are incredibly healthy companies. These are well-managed companies, and their valuations aren't at the peak that they were in late 2021 when we saw that massive correction where it was these types of names that suffered the most. So I think it's a risk worth monitoring, and I really think investors need to think about how they can augment this market cap dominant exposure that they have with areas that are cyclical and areas that are defensive, like consumer staples.
One of the some of those have done really good. Those defensive groups, those are like making highs, and a lot of these low vol funds, anti-beta funds, are the ones that are at current highs, and it seems like they're kind of threading this needle pretty well.
That's right. I mean, I think they've been forgotten over a longer period. If we're looking back a few years, something like consumer staples or utilities certainly weren't where the market action was. But certainly there's been this comeback in recent weeks, and I think if there is any doubt around a soft landing, if there is concern that the labor market is truly collapsing, that's not my base case, but it's within the range of possibility, then I think this is a reasonable addition to a portfolio today.
The cut cycle favoring the small caps, favoring that kind of cyclical stuff.
Yeah.
Usually that cut cycle happens like as the recession sort of happening, right? They start, that's the whole like uninversion of the curve, and then the Fed cuts, and you get that. And so there's this amazing opportunity to buy it kind of like at the bottom, in theory,
that's right,
of that cycle. But then it seems like the market's saying we're not going to have that like big recessionary cycle, but still buy this other stuff anyway. So is it like a mid-cycle refresh, or do we have to go through that kind of full in cycle, throw out all the garbage session still?
I think it's a big question. I think the market itself is grappling with how is this plane actually going to land. Right now we're still in the air, and people don't know how many bumps there are going to be once we hit that runway. And so my estimation is that small caps have valuation on their side, and they have the soft landing on their side, and they have the Fed cuts on their side. So tailwinds that didn't exist, a few months ago even, are now beginning to come together. So my guess is maybe we don't necessarily need to see that hard landing and then that economy rocket off to see some of this cyclical stuff start to do well. But I do think it behooves the investor to have optionality in the portfolio, to not go all in from AI, all in on small caps, all in on defensive, but to have a few different levers in the portfolio that they can turn to dependent on the environment.
I like the point about the small cap kind of odds just improving, right? Maybe it's not a sure thing because we still are in this kind of weird part of the cycle. We don't know if it's going to hit all the historical standards. SOM rule and stuff going to end,
right,
but it's basically you're betting. The small cap bet is just a bet that we don't have like a big hit.
That's right. And it puts valuation on your side in a way that the AI subset don't.
To the last point then about the portfolio, fixed income bonds, how do you kind of weave that in there now that you're not getting as much just to sit around for a couple months?
I mean, I think there's as much nuance in the bond market as there is in the equity market right now. It's been a consistent theme that it's been time to lengthen out duration because we're starting to see, those Fed cuts come into fruition and the market price them in. In fact, maybe it's past due time to start lengthening out duration. But if we start to think of a soft landing as being the dominant scenario, then you're not going to necessarily get a lot of yield movement at the longer end of the curve. So I think this is another market where you really want to dollar cost average and kind of modify and adjust your bets without going wholesale one direction or another.
Okay. Do you celebrate the dollar crashing? I don't know if you heard our conversation at the top of the show, but like people are, I don't know, it makes me a little worried.
I don't know.
The dollar's in free fall.
But the dollar has been overvalued for a long time, and we've known that a lot of that hinges on the central bank policy here in the U.S. versus outside the U.S. And so to the extent that's recalibrating, I think that things are happening as they should in the currency markets.
Okay, great stuff, Marta. Great to catch up.
Good to be here.
Thanks a lot for coming back, Marta Norton, Chief Investment Strategist at Empower. All right, great.